Welcome to the July 19th edition of Markets Demystified from ESOP Advisor, LLC. I'm your host and the owner of ESOP Advisor, Jonathan Oden. This edition, Fed Resolute, lower for longer ends. Target rate. Interest rate targeting is a fairly new practice among global central banks. New Zealand was the first to start targeting inflation levels in 1990. Though the US Fed adopted an implicit target rate of 1.5% by 2000, it increased its preferred rate to 2% after the Great Recession, and in January 2012, the Federal Open Market Committee, or FOMC, announced an explicit inflation target of 2%. Goldilocks. Although high inflation is not desirable, the overwhelming consensus among economists is that falling prices associated with deflation may be even worse. So while runaway inflation is to be avoided, some amount of inflation is desirable. The Fed considers its 2% target to be in line with sustainable growth while climbing slowly enough that most consumers will not notice. Hikes and cuts. After the Great Recession of 2008, inflation remained stubbornly below the Fed's 2% target. The Fed enacted a stimulative monetary policy in an attempt to stoke the embers of economic expansion and fuel a moderate level of inflation. In response to the economic meltdown of the Great Recession, the Fed dropped rates to 0 in 2008 and would not make an increase until December of 2015, when they hiked 9 times across 3 years from 2015 to 2018 for a total of 225 basis points. However, the Fed soon made 3 rate reductions totaling 75 basis points in the face of a trade war with China. In March of 2022, the Fed embarked on an historic economic tightening cycle, raising rates 10 times in just over 1 year for a total of 500 basis points. Coming from a long period of relatively low interest rates, the Fed's abrupt pivot from accommodative to restrictive in the face of soaring post-pandemic inflation jarred markets. Fed put. No economic sector is spared from the restrictive tools the Fed can use to tamp down demand, with share prices being influenced by investor expectations of demand for services and products. Fed tightening typically weighs on stocks. The impact of the Fed's sudden shift sent markets reeling for months, plunging as much as 28%. Frequently during market downturns that coincide with Fed activity, media pundits speculate on whether the Fed will ease any tightening activities to prevent markets from falling further. Despite more than 9 painful months of constant new lows, the Fed stood resolute in their determination to turn the corner on inflation. Although the Fed consistently declared their intent to focus on inflation, participants in the Fed fund futures markets have repeatedly underestimated the Fed's willingness to make more hikes. Rate markets have continuously readjusted their outlook for the Fed's next move. Following recent hikes, markets have priced in little to no chance of further ones. Economy unfazed. In 2022, many economists expected the U.S. to be in a recession by now. However, in spite of 500 basis points of rate hikes in a short time, labor markets and consumer spending have remained remarkably resilient. As positive economic data has continued to defy recession expectations, investors have continually raised their expectations of more hikes, with continued economic strength seen as fuel for inflation, moving the Fed to keep going. Currently, investor expectations reflect an almost certain chance of an additional 25 basis point hike in late July, whereas just a few months ago, investors expected the Fed would be done hiking. With Fed projections not calling for inflation to reach their target until 2025, when they do stop hiking, they may maintain elevated rates until inflation reaches a desirable level. Thus, the age of lower for longer may be over for at least the foreseeable future. Thank you for listening to Markets Demystified from ESOP Advisor LLC, where we relate investing to personal money management. Visit us on the web at esopadvisor.com. That's AESOP advisor.com, or call us at 940-268-4161. The preceding information is not meant as individual investment, legal, or tax advice. ESOP Advisor LLC advertisements are for informational purposes only and are not recommendations to buy, sell, or hold any asset. All investments involve risk, and the past performance of a security or financial product does not guarantee future results or returns. While diversification may help spread risk, it does not assure a profit or protect against loss. ESOP Advisor LLC does not provide tax or legal services.